it doesn't look like the bond market has fully calmed down.
No, I mean, look, today we did see the Prime Minister reverse that corporate tax change. That only saves about £15 billion. We did see her appoint a new finance minister, someone who's expected to be more orthodox and less cavalier. But we also have to remember today, Sarah, that Bank of England 2-week-long special operation did expire. That was designed to lower the long end of the yield curve to try and help those UK pension funds exposed to liability-driven investments, LDIs, to lower their leverage. And we hope over the last 2 weeks that they've done that. But that move in the long end of the yield curve higher, particularly into the close today, is a little bit of a worrying sign. But I think the takeaway today is monetary policy and the expiry of that Bank of England scheme has outweighed anything that the government could announce on the fiscal side.
So what happens to her? Is there going to be pressure on her to resign still? Or has she,
Definitely.
I don't know, fixed it with a new chancellor?
Today, no, I mean, today she's bought herself more time. The question genuinely is it days or is it months? And I think what's fascinating is markets that have pressured a new Prime Minister after just 38 days to U-turn on her signature policy and to fire her most senior minister, someone who's a close ally of hers. And it could well be markets from here that decide if she does get days or months. Her MPs, who will ultimately decide her fate from here, are dissatisfied and disenchanted, not least because of terrible poll ratings. But if the markets improve, if the markets show confidence in her government in the immediate term, it might buy her a little bit more time from here. This reset today, it wasn't a considered, careful reset in the middle of a government. It was a desperate attempt to keep the wolves at bay in the short term.
Well, clearly she got the message. So you mentioned that the Bank of England policy has been outweighing the fiscal policy, even though that's what sparked it here in the market reaction. What happens next with the Bank of England? Are they done with this emergency bond buying thing?
Well, their current policy, which was 2 weeks long, has now ended and expired, and we wait to see if it was enough. I mean, the encouraging thing was that the Bank of England governor was very clear it was going to expire today. So pension funds who had exposure to LDIs had no excuse if they didn't deleverage. The worrying thing is yields only really lowered for the first half of that 2-week period. So there is a risk that some pension funds, despite being given that window, may not have successfully deleveraged. We'll wait to see next week. And the question, if they fail to deleverage, will be, will the Bank of England do a new scheme? Or will the government confidence be enough to prevent yields rising again? We'll see on Monday.
Wilfred, we miss you, and I got to say, you didn't make the best trade when it comes to getting paid in pounds versus dollars.
Don't remind me.
Not great timing for you.
Don't remind me, and I miss you too. Thanks for having me.
All right, maybe I'll come visit you and go shopping. Wilfred Frost. For more, let's bring in former J.P. Morgan Chase International Chairman and former Bank of Israel Governor Jacob Frankel, who is at the IMF World Bank meetings in Washington. Jacob, where all the discussion is on central banking and how they should respond to inflation and now to financial stability concerns like the UK and whether those things are going to be at odds. And this is going to prevent them from moving forward with the inflation fight. What do you think?
Well, indeed, the last few days have demonstrated again that financial markets are extremely sensitive to news, extremely judging, without any mercy. They are conducting referendum on a daily basis on what is coming to them. And this means, therefore, that policies must be presented to the market in a very clear way, transparent, and clear. And I think that what is happening there now, in addition to the fundamentals that we are not going to go into, I think that the communication with the market did not pay enough attention, that the market listens and reads through when there is lack of depth in the preparation and in the presentation. In any event, the fact of the matter is that we are part of a more global scene. Central banks all over the world, and I'm now in the United States, or the Federal Reserve, for example, have been behind the curve. But it is not just behind the curve in the sense that inflation came as a surprise, but really behind the curve in a much earlier sense. You spoke about financial markets. For a long time, interest rates were kept too low for too long. And of course, it was a good reason. We need to make sure that the economy recovers, the post-pandemic and all of this kind of thing. But unconventional monetary policy must be temporary by definition. And I think that what happened here, that by pushing interest rates down excessively, investors were pushed to chase after yield. They have taken excessive risk. Pricing of risk was distorted. Corporation engaged in buybacks instead of investment in plant and equipment. And there has become, as a result, a disconnect between the financial sector and the real economy. And for a while, people thought that there is no inflation anymore. But there was inflation. It was not in the CPI. It was in the stock market, as one would expect the interest rate is zero.
Yeah, no, you were warning about that for a long time, that the asset markets were showing the inflation and that the central banks were staying too long at the party and not anticipating it. I think the question now, Jacob, is how the Fed reacts at this point. It's trying to catch up, and there are now calls for it to potentially moderate or slow down because of what's happening in the economy and in the markets. What would you say to do?
Yes, well, there were two parts of what you remarked. You said how the Fed reacts and what should it do. I think it's a general rule. The Fed should not be a reactive body. It should be an anticipatory, a leading body. Should drive the car through a front mirror rather than the back view mirror. It should look forward. And therefore, the statements that said we are data dependent, we will not move until we see it in the data, forces to be behind the curve. So fortunately now, everyone realizes that this was a bad strategy and we need to look forward. But the question is, what now? First, there is a large gap that has been created from where the Fed needs to be to where it is. So it is clear, and that's why the steps were very welcome of raising interest rates with significant steps of 75 basis point each round, and I expect it to continue in the next Fed announcement. The question is now, however, what next? Should the Fed yield to the calls of saying, be careful, go slowly? I think that one of the... You think
not?
Well, I am sure not. And the reason is that one of the important instruments of central banks is credibility and clarity. So therefore, by being behind the curve for so long, some credibility was eroded. So one of the purposes of raising interest rates now is first to move to the right direction, to the right place, but also to rebuild credibility. I want to say one more point. We are focusing on the interest rate as if this is the main issue. It's an important one. But during the period of QE, a lot of assets were accumulated in the balance sheet of the central bank. And now we are going to the phase of QT, namely quantitative tightening instead of quantitative easing. When you are talking about quantitative tightening, the quantities that we need now, or the Fed needs to transmit to the market, the quantities are huge. And therefore, can really unsettle equilibrium. One needs to go slowly, but in a very clear way, and the path need to be declared in advance. I would not, at any event, give up today the fight against inflation, because this is the sine qua non for monetary policy. Let's admit, much of the trouble that we have did not come from monetary policy. We have a war, we have food, we have health, we have energy, we have all of these things that have nothing to do with monetary policy. But unity is still key.
Well, Jacob, point received. Thank you very much for coming on and sharing some of your views and what you think central bankers should be doing. I know you're doing that all week long at the IMF World Bank meetings. Appreciate it. That's Jacob Frankel, former governor of the Bank of Israel. Looking at the Dow, down about 323 points or so. S&P's down 211. You've still got every sector lower. We're a little bit off the lows of the session, which we